Hi, and very welcome to Pareto TV. I'm here today with Harry Colvin from Longview Economics. We're here to take a look at what to expect for equity markets in the near term, and also look a bit on what we can expect in terms of how deep and long the recession will be, and whether policymakers have done enough to help us into a V-shaped recovery later in the year. Please, Harry, start off.
Great. Well, thank you. Thanks for having me. I think the first thing to say on equity markets, if we flick over to Fig 1 on page 2, is that clearly complacency in the near term has begun to re-emerge. And, you know, we've had lots of stimulus. We've had early signs that lockdown measures have started to work. The S&P's rallied about 33% in the last 19 trading days. And I think what's interesting about this recent rally is that, as is often the case when markets move very sharply, the consensus thinking has also changed. So we've had all these calls that markets would retest the lows. Well, those calls have now faded away. So various strategists from investment banks have given up on their bearish view. The media commentary was bearish, and it's now become much more optimistic. And that change in sentiment is really what we're measuring in this indicator. This is our risk appetite model, and you can see that it's back on sell. And I think the interesting thing, if we flick over onto the next page, is that while many people have given up on the expectation that we retest the lows, you can see from this table that there is almost always a retest of the lows. So, you know, many commentators have given up on the view. So from a contrarian perspective, the history of stock market pullbacks has quite a compelling message at this time. So what we're showing here is that, you know, since 1978, there have been 15 S&P 500 corrections within bull markets in which the initial pullback was 10% or greater. And in 13 of those, the index then went back to revisit, to retest its lows. So 87% of the time, you get the retest. And the interesting thing is that on those two occasions, you can see where the S&P didn't retest the lows. Both were small pullbacks at around 10, 11, 12%, and neither of them were associated with a direct macro shock to the US economy. So we've got sell signals, we've got complacency, and we've got the history of our indicators. And if you flick onto the next page, you can see that in early 2018, we had a similar sell signals. We had a relief rally after the initial wave of selling, a sell signal from our risk appetite model, and then we went back to retest the lows. And in fact, if you go over the page, many of our medium-term models have a good, if you flick onto page 5, have a good track record of picking the local high in the relief rally and signaling a retest of the lows. So this is the Jan 15 example and the summer of 15. And then on top of that, as you can see on this page, there's plenty of signs of financial stress in the system. So credit spreads remain quite high. They remain high in the case of Asia and Latin America. That's what you see on the bottom right chart. And then in Europe, you can see spreads have been widening in recent trading sessions. So models are on sale, and financial stress levels are high. So that's really the outlook for the next couple of months. Our base case is that we get a retest of the lows in equity markets, and maybe something more later on. It really depends on the glide path of the US economy, which is what we come to on the next page. So you'll see on US household cash flow. Before we get into this, I would just say I think the really key question is, you know, really how deep and how prolonged will the US recession be? I think that question's critical for determining how long and deep the bear market in equities is. And really that hinges on two things. One is how well the virus ends up being contained, and then the second is how successful policymakers are in limiting the transmission of this demand shock to the supply side of the economy. So if they're successful in doing that, then they enhance the case for a V-shaped recovery over the course of coming quarters. And in that sense, the policymakers have done a lot. They've announced this CARES Act. They've passed it. It provides relief and stimulus really on two key fronts. Firstly, by supporting businesses, and then secondly, by supporting households. And this is really what we examine here, the outlook for household cash flow and whether or not households are going to be retrenching. So over the course of coming months, US household cash flow is going to be buffeted by three sort of key cross currents. One, of course, will be the fall in wages and income and lower income from rents and interest and dividends and things like that. But that's going to be offset by two other factors. Firstly, there will be clearly savings on certain goods and services, so savings on gasoline and travel and mortgages and hotels and things like that. But also, and most importantly, there will be a big cash injection from the government, from the CARES Act, the tax rebate, and the enlarged payments coming from this more generous unemployment benefit scheme. Now, normally, household cash flow averages around 130 billion a month. That's been the average for the past 12 months. That's all income, less taxes and spending, and it's really what's left over. And on our analysis, given all those factors above, so cash savings as well as the tax rebate, cash flow post-tax, post-spending is going to rise by around a factor of 5. So it'll go from about 130 and it's going to go up to about 630 over the course of April. And then it comes down in the months that follow that. So it's an enormous cash injection. And overwhelmingly, the biggest driver of that will be the tax rebate. So these are one-off payments made by the government of $1,200 for those earning below $75,000 a year. So it's quite big. You can imagine a household with two adults and two children. You also get a $500 payment per child. So a two-adult, two-child family with an income of $150,000 or less would receive a one-off cash payment of $3,400. So quite a big cash payment coming from the government. That's the blue bar, most of which comes in April. We've assumed that May, June, July, and August, there'll be some legacy payments made from that scheme. And then on top of that, the green bars show the extra top-up payment from the federal, at the federal level, an extra $600 per week for those unemployed, which lasts for 4 months. So that's the green bars, extra government assistance for those who've lost their job. So big payments which significantly inflate household cash flow. And if you flick over to the page, it's really that extra cash flow as well as what you see here on page 9 and that Fig 10. You can see this big savings in this is spending on transport. It falls very significantly, but there are on our numbers about an extra 270 billion of savings in April relative to February levels from things like gasoline savings and savings on not spending money on hotels and restaurants and things like that. And of course, on our one lockdown model scenario, that then recovers later in the year. And what we've done, if you go on to the next page, is we've taken that cash flow analysis one step further and taken a look at what it really means for household spending. What shape is spending likely to take? And our main assumption is that cash flow is just kept the same, and what's saved is what's in excess of the normal cash flow levels is then spent. And you can see that if you can see spending then recovers very sharply. That's our blue line on the bottom one. That's our sort of base case scenario if as the economy bounces. I think the interesting thing will be the red and black lines. Now what these show is that, assuming households spend either 25% of the extra cash they save or even 50% of the extra cash they save, then we're looking at a much sharper increase in household spending over coming quarters and a much more V-shaped type recovery. So that's, of course, assuming one lockdown. Of course, it dips further in Q4 if we get a second lockdown later in the year. But the key point is that there's about $1 trillion in stockpiled cash that is then likely, much of which is then likely to be spent in the second half of the year. So from a household cash flow perspective, there's a very good argument to see a V-shaped recovery as much of that extra cash is spent.
Do you have any probabilities between the two scenarios with a sort of the one V-shaped recovery or a second lockdown, or have you given any thoughts on that?
Yeah, I mean, I think it's highly likely that a very large portion of this cash stockpile will be spent over the next couple of quarters and really into the back end of the year. So I would say actually a no spending of spare cash, which is the blue line, is really quite unlikely. Much more likely that we see at least 25 to 50% of that cash spent. I think we're more likely we're looking at a sharper V shape. This is, of course, assuming no other lockdowns. Leftover likely to be spent in 2021 if it doesn't all come in the second half of the year.
How would you describe the policy response compared to earlier times? I guess that's not too common event, but just give a brief description of your view on that, please.
Yeah, I think the policy response has been very aggressive. On the fiscal side, they've done about $2 trillion. That's about 10% of GDP. That's very large. The Fed are, of course, part and parcel of that response and are creating money to buy assets. Not least, they're buying treasuries and they're essentially funding the fiscal deficit. But also, as we know, they're buying credit as well. So buying not just investment grade, but they're buying newly downgraded high yield credit as well. So there's plenty of liquidity in markets. I think a very aggressive response. If you think about the speed of the increase in the size of the Fed's balance sheet, it's been much faster than what it was, for example, in 2008 and 9. So far, very aggressive, and by the looks of things, they stand ready and willing to do more. And I suspect if we have another lockdown later in the year, then that's when we would see more policy response in the US.
Yeah. Well, thank you, Harry, for a great presentation today. Very interesting. Looking forward to hear more about these issues in the near term. Thanks.
Brilliant. Thanks for having me.